If you currently have an FHA loan and you need to move, you might assume that you have to sell your home before you can buy another one with FHA financing. That assumption is understandable, and in most cases, it's accurate. FHA loans are designed for owner-occupied principal residences, and the federal government's policy is that FHA will not insure more than one property as a principal residence for any borrower, except when it will. There are 4 separate situations where HUD allows a borrower to have a second FHA-insured mortgage without selling or paying off the first one. Most people who are in one of those situations have no idea the option even exists. That's what this video is about. Before we get into the exceptions, it helps to understand why the rule even exists, because the reasoning makes the exceptions easier to follow. FHA mortgage insurance is a government program designed to make home ownership more accessible, lower down payments, more flexible credit requirements, and more forgiving debt-to-income ratio thresholds. That makes FHA loans a meaningful pathway for buyers who might not qualify for conventional financing. Because of those advantages, FHA loans are specifically limited to owner-occupied principal residences. A principal residence is the property you live in for the majority of the year, so it's your primary home. FHA won't insure investment properties, and the one property at a time rule exists specifically to prevent borrowers from using the program's advantages to acquire rental properties or investment homes. The 4 exceptions exist because life doesn't always cooperate with policy. There are real situations, so job relocations, growing families, divorces, family assistance, when requiring someone to sell their current home before buying a new one with FHA financing would create a genuine hardship without serving any legitimate policy purpose. Each exception has specific requirements. The more clearly your situation matches one, the more straightforward the path forward becomes. The first exception is relocation. So if you're moving for work or you've already moved and your new home will be more than 100 miles from your current principal residence, you may be eligible for a second FHA insured mortgage without selling the first property. The 2 requirements are very straightforward. You must be relocating or have relocated for an employment-related reason, and your new principal residence must be more than 100 miles from your current one. The 100-mile threshold is important, so this exception is specifically for situations where commuting isn't a realistic option, not for situations where a borrower simply wants to move and keep the old property. One thing worth knowing about this exception, if you later move back to the same area, you are not required to return to your original home. So you can obtain a new FHA mortgage on a new principal residence in that area as long as your relocation still meets the 2 requirements above. Now, the question most borrowers in this situation immediately ask is, do I have to qualify with 2 mortgage payments? In most cases, the answer is no, and here's how that works. Rental income from your departure residence can be used to offset that payment as long as an appraisal documents at least 25% equity in the property you're leaving. And you have to have a signed 1-year lease, and you can provide proof of the security deposit or first month's rent. So if those conditions are met, the departure residence payment does not have to be counted in your debt to income ratio for the new loan. That's a significant relief for borrowers who were worried about qualifying with 2 mortgages on the books. The second exception applies when your family has grown and your current home no longer meets your needs. To qualify under this exception, 2 things need to be documented. You've had an increase in legal dependence, so not just a desire for more space, and the current property genuinely fails to meet the needs of your family because of that growth. There's also an equity requirement that's specific to this exception, so the loan to value ratio on your current principal residence must be at or below 75%. That means your outstanding mortgage balance needs to be no more than 75% of the property's current appraised value, verified by a current residential appraisal. So this requirement exists for a practical reason. If you have at least 25% equity in the home you're leaving, the argument that you're retaining it as an unintended investment property is much weaker. You've built real equity, you have a legitimate reason to move, and the math supports it. The same rental income offset rules apply here as with relocation. So if you can document the 25% equity with an appraisal, secure a 1-year lease, and show proof of the first month's rent or security deposit, that existing mortgage payment can be excluded from your debt to income ratio on the new loan. The third exception covers situations where you're leaving a home that you own with somebody else. and that person is staying. The most common scenario is divorce, but it applies to any situation where you're vacating a jointly owned principal residence with no intent to return, and an existing co-borrower will continue to occupy it. So this exception has two possible paths for handling the existing mortgage payment in your debt-to-income ratio calculation, and either one can work depending on your circumstances. The first path is a final divorce decree that awards both the home and the debt to your ex-spouse. So if the court has documented that the property and the mortgage obligation belong to them, you may be fully exempt from including that payment in your debt-to-income ratio. The second path applies when there's no such decree or when the situation isn't a divorce. So if the remaining occupant, co-borrower, has been making the payments independently and has a documented 12-month on-time payment history, that payment can be excluded from your debt-to-income ratio as well, but the key there is independently paying. So that's not going to be from a joint account, that's going to be from an individual checking or savings account. The key word in both cases is documentation. The lender needs to see evidence, either a legal decree or a 12-month payment history, before they can exclude that obligation from your qualifying ratios. The fourth exception is one that catches a lot of people off guard because it works in the opposite direction from the others. The non-occupying co-borrower exception applies when you're previously co-signed on someone else's FHA loan, a family member's home, for example, without living there yourself. Under HUD 4000.1, a non-occupying co-borrower on an existing FHA-insured mortgage may qualify for their own FHA-insured mortgage on a new property to be their own principal residence. So the logic here is the same as the others. The purpose of the one property rule is to prevent investment property acquisition through FHA. So if you co-signed on a family member's home as a non-occupying borrower, you weren't living there, you were helping someone qualify. So getting your own primary residence with FHA financing doesn't contradict the spirit of the program. The debt exclusion works similarly to the jointly owned property exception. If the occupant borrower, so the family member who's living in the home that you co-signed on, has made timely payments for the last 12 months, that mortgage payment can be excluded from your debt-to-income ratio calculation for your new loan. If the payment history doesn't meet that threshold, you may still qualify, but both payments will need to be counted in your debt-to-income ratio. Whether that works depends on your income and your overall financial picture. A few things worth understanding before you move forward. Each of these exceptions is evaluated on a case-by-case basis. Qualifying under one of them doesn't mean automatic approval, it means you're potentially eligible. The lender still needs to verify that your situation genuinely meets the requirements, that your credit and income support the new loan, and that the overall transaction makes sense. FHA loan limits also apply to these new loans. So for 2026, the national low-cost area limit for a single unit property is $541,287, and the high cost area ceiling is $1,249,125. So if you're in a high cost market, your loan amount for the new purchase needs to fall within the applicable limit for that area. And the fundamental requirement of FHA financing still applies to the new property. It must be your principal residence. So these exceptions allow you to have two FHA insured loans at the same time, but both have to be legitimately tied to your housing situation. Using these exceptions to acquire rental or investment properties isn't permitted, and it isn't what they're designed for. FHA financing offers advantages that matter in real situations, so lower down payment requirements, more flexible credit thresholds, and greater accessibility for borrowers who don't fit the conventional loan mold. For someone going through a relocation, a divorce, or a life change that requires a move, losing access to FHA financing could be the difference between being able to buy and being stuck. Knowing that these exceptions exist and understanding which one applies to your situation changes the conversation significantly. For the right borrower in the right situation, that's the policy working exactly as intended. If you currently have an FHA loan and you're facing a move, whether it's a job relocation, a growing family, a divorce, or something else entirely, the fact that you already have an FHA mortgage may not be the obstacle you think it is. If you want to understand whether your situation qualifies for one of these exceptions and what the path forward might look like, use the link below to book a call with my team. These conversations are worth having early before you assume you're limited to options that don't include FHA financing. And if you want clear explanations about how mortgage programs actually work in real-world situations, make sure to hit that subscribe button. My goal is to help you make informed decisions with confidence and ultimately win with Wade. We'll see you in the next one.